Welcome, friends. In this edition of the live virtual classes meant for the May 2027 and onwards examination, ICAI Ashish Gupta, Joint Director Board of Studies, welcomes you all. Now, student, as we have in our earlier class, we have started the topic security analysis, and this is our first chapter. It was a first, basically, it is a first chapter of the section 2 of our syllabus, Advanced Financial Management. So today it is the second part of this topic, security analysis. And and today's I think good morning, beta. Good morning, Ravinder. And today we shall cover up this topic. Now, in the first part of this lecture session, I will cover up the theoretical aspects. Of course, some charts are there and some other things are there. Then in the second part, I will cover up the assignment with you. Assignment upload कर देता सब website पे assignment है इसका ये करना है. Okay, I will take care. So we shall take up the assignment. Okay, in the second part of the session. So student and these are some. If time will be available, then there is in assignment there is one case scenario as well. So assignment consists of some questions. Then we shall take up some case scenario. One case scenario we shall take up. So let us start with the technical analysis. Now, student, please note that this topic of security, when we talk about this topic of security analysis, there are some disclaimer from our side that one second. There are some disclaimers from our side. First of all, these are for academic purpose only. Our purpose is basically purely academics. Please don't indulge yourself in the trading after referring over this lecture because these are meant only for your academic purpose. And very important that since technical analysis is a very wide topic, even security analysis also a very wide topic, but especially the technical analysis is a very wide topic. So, but however, we have covered here a limit, we have kept our scope very limited because seeing that there's variety type of charts are available, variety type of techniques are available. So it can go in, as I have mentioned, the last class basically is a separate subject. So, but since it is only one chapter is here, so technical analysis we have also kept very limited. So of course we shall try to cover as much as possible. But my request to you, please, student, don't ignore the study material. Please refer study material. Although I will cover important topics in today's class, if anyone thing has been left, please refer the study material. Okay, please don't skip any topic of the study material that sir has not covered it. Okay, keeping this mind. So all topics of the study material you need to cover thoroughly. So let us start with our discussion. Now, when we talk about the technical analysis, so what is exactly the technical analysis? It is something, if we see the definition, not it is exactly definition, it is some description. It is a method of the share price movement based on the study of the price graphs chart on the assumption that the share prices trends are repetitive. So there are some keywords, okay, that I am just reading. Investor psychology follows certainty pattern. What is seen to have happened before is likely to repeat it. It is very important, student. Please remember that. तुम्हारी वेबसाइट उसमें ईमेल लगी हुई है किस वो जस्ट लोगो. One second, student. Just so one of the very important keywords are here. Now let us see what are the keywords. These are some keywords. First of all, graphs and chart. So sometimes even technical analysts are also called chartist. Okay, on the assumption that share prices moves in a trend. Okay, and these are repetitive in nature. Okay, so something has been had in the past is likely to happen in the future again. Basically, technical analyst is not concerned with the fundamental strength or the weakness of a company or an industry. It is very important. Or industry. He or she studies investor and the price behavior. Now, it is very important to note that they are not concerned with whether what is the strength and weakness of a company. They are just go by the trends. What is in demand and supply? Basically, if we see that, basically it is a play of demand and supply. Even psychology also plays a role. Okay, if there is a very famous word you have heard, buzzword is FOF, fear of I think it is called fear of missing something. I think fear of missing out. FOMO. Okay, fear of missing out. So fear of missing out means generally whenever a market is in a boom, everyone wants to make the money because they say, why should I leave the chance? So all this happens from the technical, mainly technical analysts are mainly concerned with the movement of the market, while fundamental analysis let us know where to invest. Technical analysis helps to us to know when to invest. It is basically more concerned with the timings. So we are saying that they are more concentrated with the timings. So it is one of the very important point. And what is technical analysis attempt to answer two basic questions. One is there any discernible? It means it is a detectable. What is a detectable? Any trend is there in the prices? And if yes, then there are some indications that when trend would reverse. Okay, so we have to analyze what is the trend and when this trend will be reversed. So all these are taken care. Now, basically, technical analysis is looked out from the behavioral lens. Okay, we can say that relies because it is, as I told you, it is basically a psychology of the investor. So we can say that technical analysis asserts that market value is dictated entirely by supply, demand, and human psychology. So these are the three key we can constituents of the technical analysis, where we study analysis of supply demand situation and human psychology as well. Generally, you have seen some on some business channels like CNBC News, etc., where some technical analysts are there and they present a chart, etc., and on the chart they generally predict the trend reversal, etc. Now, whenever the question comes, what is the trend? Basically, student, I just tell you, trend means generally if we see that trend is like this, it is generally something like here. If we see that if I join these lines, it is a trend. So we have to join top or the downward prices of any chart. Like if I say the prices are moving like this. So if I join these lines, this is the trend. Okay, so we have to join top or down. It indicates the trend. Okay, so generally in the case of a bull market means there are some terms I will use, and that may be in a generally bull market. We say the prices are going up. Okay, so this is the rising trend. On the other hand, it is a downward trend. So one of the very important thing we have to note it, trend is a very important thing. So first, when we talk about the assumptions, okay, what are the core assumptions? First, market is driven by purely demand and supply, rational or irrational. Very important. Sometime there may be the demand for the share who does not have any profit. Okay, there does not have any growth prospect, but still demand is there. So it can be rational or irrational. It is goes by demand or supply. They are not concerned. Whereas because in the fundamental analysis, the logic is that there should be rationality there. And then is the price moves in an established trend. Okay, that I told you. I have discussed with you. Trend means when we there's a downward is there, like prices are going down. So we join the lower points there. Okay, and it is called trend. Similarly, in a bull phase, we join the up. It is gives us a bull trend. Now, very important. History repeat itself. It is one of the very important logic. Okay, history repeat itself. This is the main basis of the technical analysis. It means whatever has happened earlier, it will happen again. Okay, that's why we can see that there are many situations in the worldwide markets, especially whenever we talk about technical analysis. So basically, Wall Street, like in India, we have a BSC and NSC is our main market. Like in a USA, the basic very important market is Nasdaq, and there is also the market of Wall Street. Wall Street is generally considered to be the finance is a stock market indicator. So whenever we talk about the Wall Street, so Wall Street means a stock market is there, and ultimately, when we talk about the Wall Street, they have developed so much theories and they have advanced in this field so that they even predicted they can they have developed some theories that they can predict the trend reversal, because very important, very I'm just tell you what is the ultimately purpose of technical analysis. Technical, whenever we have to discuss about the technical analysis, it is a basic one of the another criteria is that we have to buy at lowest and sell at highest. Okay, we have to buy at lowest and yes, S&P 500, Dow Jones. These are indexes. Okay, of course, these are the cycle and these are the indexes. You are right. These are the some indexes. Okay, so these are we can say that buy at lowest. We have technical purpose analysis to buy at the lowest price and sell at the highest price. Only then the purpose of the technical analysis and all is served. Okay, because in case of a fundamental analysis, generally we go by the long-term perspective. Okay, so they don't do buy and selling so frequently. On the other hand, in technical analysis, buy and selling are so frequent so that they generally buy at a lowest rate and sell at a highest rate. So there they have to identify at what point of time they have to buy and at what time of point they have to exit the markets. So that's why it is concerned with the timings of the market. Then analytical horizon. It is very important. It is one of the very differentiating factor from the fundamental analysis. Now, while the fundamental analysis operate on a long-term basis, that is 3 to 5 year horizon, the technical analysis operate on a short-term window mapping human reactions. This can be month, days, or even hours. They're buying in the morning and selling in the evening. Okay, so we can say that long position in the morning and selling in or shortening the position it is also called intraday trading. Okay, it is also called intraday trading. So generally, as per the SEBI and RBI, generally mainly the SEBI, they promote that investors should not indulge in the intraday trading. Retail investors, especially, of course, traders are there. They can say they are in the market and so they can make the profit, etc. But for an retail investor, it is always better they go for a fundamental use a more use fundamental analysis to invest it for the long-term horizon. Then when we talk about the technical analysis, one of the important name is Dow theory. Okay, and when we talk about the Dow theory, so it is we can say that he is the father. He was the father of the technical analysis theory because he was basically the first person who has propounded the technical analysis. And here, what he has done, he has basically analyzed the prices of the prices of the various shares vary for I think 50 to something years about, and in around 1902 he has published some articles on the price trend. Okay, yes, and trend on a price trend. So, but before anything could he could proceed further. Unfortunately, he died. So, in after his death, there are there are two authors. One was I think it was William Peter who has compiled his articles. Okay. Then in 1932, there was another author, Robert Treher, okay, published these articles in the known as Dow theory. Okay, basically, according to the Dow, we can divide the overall trend in a three phases. Okay, we have, and this is the anatomy of the trend. Okay, they compare it with the, we can say that they compare it with the trend compared with an ocean, or like an ocean metaphor. Okay, they compare it with the waves in the ocean. So they say there are three type of trend. One is, sorry, one is primary trend. Okay, these can be compared with the tide in the sea. Okay, and why it is a primary trend, and their generally we can say that their life is we can say that it runs from the sorry, here it is one the 12 months to 36 months. Okay, so generally their period is from the 1 year to 3 years. Okay, we can say that their period is 1 to 3 years, and that's why what happens, they are generally determine what is are the direction of the market. It can be bull or bear phase. Now student, when we talk about bull generally means the rise in the market or the growth in the we can say upward trend in the market, whereas a bull means the downward trend. Okay, so this is a, they have identified what are the basic long term trend is there. Now then they comes to the secondary trend. Okay, these secondary trend are somewhat corrections. Okay, generally they go in the opposite direction of the primary trend. Okay, they go in the opposite direction of the, here the market, see here the market rising, but they are some downward. So they are somewhat called the opposite, they move in the opposite direction of the primary trend. Okay, they are move in the opposite direction of the primary trend. So now ultimately what happens, then there is a comes the next point is, so they compare it with like in ocean, they are compared like waves. Okay, they are just like the waves in the sea. Okay, tide is very high, waves are very small, that's comparatively small. Then ripples are the day to day, or it is also called minor fluctuation. It is also called the minor fluctuation. Again, these are opposite to the, it can be opposite to the secondary trend. So generally what happens, there little bit corrections are there. This is a daily fluctuation. Okay, it is also called the ripples. So if you go to the any sea, okay, if you go to any sea and you watch it, so the waves are coming down and up, like these are going up. So these are somewhat secondary trend. Whereas if you see, there are some ripples in the water of the sea. So this is called as a ripples. So he has compared like this. Now, according to Dow, he has ultimately come. Now, what was the theory basis, or what we can say, what ultimately he propounded that tenets. We can say that some principles of the Dow theory are. that market discounts everything. Okay, market discounts everything. It means market reacts to any information. Okay, it can be any data. Okay, data like GDP or anything. Okay, it can be an data like GDP data, employment data, whatever, with even corporate information, whatever we may, market discounts everything. Sometime even it has been seen that uh, maybe sometimes some information may be known or maybe unknown, but market reacts to it. Okay, then there are three market trends. We have discussed the same. Okay, so what are the three phase? These are the trends that we have discussed. Now, next is comes primary have a three phases. Now, what are these three phases? Whenever we talk about the three phases, generally these are the phases are like this. One sec. Accumulation phase. Accumulation. These are the accumulation phase. Okay, and then here next phase is public participation, and then is excess phase. Okay, generally what happens, like in case of a bull market, whenever any market positive market trends are there, traders start buying the shares. Okay, once they start buying the share, then it comes the public participation. Okay, public also start participating in the same. Sai Kiran, I will come to this. Okay, you are going some far forward. I will come to here. Okay, of course, particle share is present in our. I will discuss with. Okay. Then here next is the excess phase. Excess phase when there are too much participant in the market. So in case of a bull market, what happens? Initially, when the prices start rising, so some traders are there, then public comes into the picture, they start buying it, and once the buying is too much, the public start holding the share. Then when there is anytime there is a still slight stagnation in the price is there, so there will be a panic among the public. Okay, so they will realize that we have excess, there is excess buying there, so they will then start downfall. Okay, so this is are the three phases generally in any trend. Okay, generally these are it can be bullish phase, bullish trend, or is a bearish trend. So next is indices must confirm each other. It is very important. See, there are many indexes. Okay, Dow Jones has as per Dow Jones there are two indexes they were used. I think it was Dow Jones Industrial Index and Dow Jones Industrial Index, and there was Dow Jones Railroad Index. So they have used this, but for so far in the like for if we talk about the India, in India we have it to many indexes like Nifty, Nifty mid cap, small cap. Okay, I think here the Nifty, and there is a Nifty small cap, Nifty bank. So see, generally what happens when these are there are so many indexes are there. So it is very important that they should all move in, like if there is a bullish trend. So it does not mean that one index is rising, another is falling. So almost all are falling, all are rising, but there may be the difference in their rising rate, but all are on a rising mode. So this is we call a bull phase. Now in a bear phase, when all should be on a filing trend, all will be in a filing trend. It depends. The percentage may not be the same, but they should be have a. So ultimately, we can say that they are indices means number of indexes should confirm the trend each with each other. Okay, volume must confirm the trend. It is very important. Okay, volume must confirm the trend. Okay, it is very important. And now let us see what he has said. He said that whenever see when there is a prices are rising. Okay, so when prices are rising, what is the volume? Volume is number of trading, number of shares traded. So it, according to him, the price change in itself does not have a meaning unless and until it is, we can say that it is supported by the similar or kind of a trend in the volume of or the sale of purchased shares. Okay, according to Dow Jones, we can divide it, we can analyze when we have to buy and when we have to sell. According to him, the buy signal is generated. Okay, price goes up, supported by increased volume. So whenever prices are going up and there is a trend of increase in the volume, so it is the best time to buy the share. Okay, because market is going on a bullish phase. Now next is a sell signal. Okay, when the sell signals are generated, prices are down and volume is also down. Okay, so it is a square of the position by the trader. Generally, square of at this moment of time, the trader square off their position because prices is down and volume is very less. So what they do, it means there is a chances that there is a bearish phase is coming out, and so at this time it is always better to book the loss. Okay, it is always better to book the loss so that because when the volume is less, it is indicating that there are there are lesser buyer in the market and supply is on a higher side. Okay, so it is the best time to sell the square of the position means just write off your position. If you have taken a position like on a short mode, you just take a long position. Then if prices are going down but volume is going up, so it is the best time to buy the shares. Sorry, it is the best time to short the position. Short the position means you sell in advance. You sell the in advance because see, when the selling volume is higher there, it means there is a panic in the market. Okay, so everyone will like to sell off their shares. So it is a better today. What is how we take the short position? Let us see. Now today, say is 12th August. Okay, you sell the share, any particular share, say at rupees 60, you short the position. Okay, now say you have to make a delivery on the 14th. Okay, so at the time, seeing the price trend, the price is likely to be maybe 57 because ultimately it is an indicator that the prices are going down. So it is always better you buy the share and give it to the seller, okay, to the buyer because you are the short position, so make a profit of 3. So from this you can analyze at what time you have to enter into the market and what time you have to exit the market. Then last point, it says trend continues until a clear reversal occurs. It is very important. According to Dow, of course, primary trend continues, but corrections are there. But unless and until any clear indication occurs, reversal will be. You have to judge at what time the reversal is going to there. Okay, temporary and like correction phase, etc., has to be ignored. But you have to analyze the primary trend. Okay, once the primary trend is, because primary trend have some period. So if you see that there is a boom in the market, so okay, continue to invest or continue to holding. The moment when it start downwards, so it till the time it downwards, the bullish phase continues. And very important, according to Dow, we should, for our analysis, always use the closing prices. The prices, there are, see beta student, there are 3 prices, there are 4 prices when we talk about and further charts. Generally these prices are, first is opening price. Okay, at what time, at the first trade, this is a price at which the first trade taken place. Then highest price. Okay, what is the highest price that has gone in the complete day? Then the lowest price, and the last is close price. So according to the Dow, we should consider the closing prices for our analysis, because these are considered to be a very sacred one. Okay, and this we can say it is we can consider it as a final evaluation of the day. Then we are coming to the next theory, that is called elite wave theory. Now, elite wave theory is somewhat developed by the Ralph Nelson Elliott. In somewhere around, he developed this theory in 1930. Okay, in 1930, somewhere here around in 1930s, he developed this theory, and according to him, we can predict the market movement. Okay, according to him, the market movement are predictable. So what he has done, he has changed that he has ultimately he has drawn out a cycle. Okay, we can say he has drawn out a complete cycle. So overall, he has said that we can draw out a complete cycle into 8 wave cycles. Okay, complete, or we can complete phase. Okay, we can say that it is somewhat a rhythm. Okay, what they say, it is we kind of a rhythm. Okay, pattern. It is a kind of pattern we can we can it can we can divide it into 8 wave cycles according to him. So he has also said that these are comparable like as a waves. Okay, so he has divided this into 2 category of waves. One is impulsive wave, which is also called motive waves. Okay, then another is corrective waves. It is also called diagonal waves. Okay, when when we talk about impulsive wave, so these are waves, are those waves which are we can say shows the primary trend. Okay, these waves are shows the primary trend. They are generally concerned with the primary trend, primary or basic trend. Okay, these are corrective waves as it names. So generally they are opposite to the primary trends. So let us see here. This is the wave number 1. Okay, so it is rising. Okay, there is a small correction here. There is a small correction. I just show it by another pen. it is somewhat rising. Okay, a small correction here, then again it is going to rise. So we can see here the difference. Okay, so if we see from the difference between wave 1 and wave 3, okay, so it is somewhat, we can see that it is somewhat 1 3 are impulsive waves. Similarly, when it goes up here, so it is somewhat, we can say it is somewhat a bullish trend. Okay, it is somewhat a bullish trend there. So it indicates bullish trend there. Now, according to him, after it reaches here, then it start coming down. Okay, so these are some corrective waves. When we talk about these corrective waves, these all are corrective waves because they are in a opposite direction of the primary trend. So it indicates that now it is the next starting of the next phase. It is the starting of the next phase because here again the price will go down. Okay, then it will slightly go up, then again go down, slightly go up, again go down. So here next bearish phase will be started. It is the opposite of this bullish phase. So according to him, what is the best point of entering into the market and what is the best point of exit into the market? According to him, it is the entry point is at a wave 2 and exit point is wave 5. Okay, it is a more highest peak. Okay, if we see that how we identify this trend, now we see the line here, that is this line is the highest longest line comparing to this line. Okay, this line is also long but it is slightly lesser than it. So somewhat it indicates that of course this point is the best point, but up when we reach here, so it indicates that there are some indication that the market is now moving into the bearish phase. Okay students, so this is it was a Elliott wave theory, and even according to Elliott wave theory, he has somewhat exhibited related it through the number. Okay, because here according to him there was one mathematician, if you ever heard the name Fibonacci, I think his name is like that, somewhat its name like this Fibonacci. According to him, their numbers are moved in some particular random in a trend. According to this trend, he has determined these ratios, and on that ratios, he said that when ratio is nearby, like fifth price is there and Y price is there, so there we determine the ratio. When the ratio is nearby it, we can exit the market. So even he has linked it with the numbers. So it indicates when we can exit the market by using these ratios as well. So this was the Elliott wave theory. Of course, almost the results are both theories are same. Only the way of presentation and prices trend is there. Now next theory is a random walk theory. It is one of the very interesting theory, and in somewhat we can say that it is it was invented by 19 propounded by the 1973 by the economist. Okay, he has popularized this theory in his book Trump name in the he has propounded in 1973. He has written a book. The name of the book was A Random Walk Down Wall Street. According to him, he contradicts both theories, Elliott wave theory and Dow Jones theory. And according to him, we cannot predict the market. Okay, we cannot predict the market. It offers, and they say that past prices does not any help us to predict the values, because they said the price move in a random manner. Okay, the price move in a random manner, and very beautifully, I think someone author said has said, random in a random walk theory can be compared. Prices can be compared with or analoged with a drunkard man standing on the one side of street. When he start moving from one corner of the street to the other corner, so what it will be, the if a fully drunkard man, then how he will move. So according to it, very beautifully is presented like this. This is a street. Okay, there is a drunkard man here, complete drunkard. Now suppose if this is a point 1 and now he has to come to this point. Okay, so or we can say if he has to come to this point, say. So now how he will go? If a man is a simple man, non-drunkard, and he is a normal man, a sane man will come this way. Okay, but since he is a drunkard man, so how will he will move? He will move this way, this way, this way, and even go back, then this way, this way, this way. So according to him, the prices does not have any particular trend. It cannot be predicted. So he has compared like this. Okay, so according to this theory, we cannot predict the market is completely unpredictable. Of course, it is quite nowadays. We cannot say use this theory does not hold true, because of course we can predict the price, but still some randomness is always there. Okay, we cannot completely ignore it. Okay, when we talk about these assumptions, unpredictable and random variable causes share price movement. The past trend is unreliable in predicting future, contradicts assumption, history repeats itself. Basically, this is one of the main contradiction of the assumption that history repeats itself. Attempts to outperform the market involves taking unjustifiable risk and significant risk. So according to him, as per technical analysis or all analysis, see, whenever we have taken the fundamental analysis, we have discussed that there is a risk return kind of a trade-off. Higher the risk, higher the expected return. So according to this theory, whatever you are making the investment or whatever you are venturing into the investment, that has to be that will be very risky and have a unjustifiable risk. According to this, you do stay away from the market. Now, next thing we are coming with the charting techniques. What is this charting techniques? Now, see, theories are there. Now, next part is coming charting techniques. Charting techniques means we analyze the charts. When we talk about the charts, there are different variety of charts available. Okay, of course, if you go by, some sites are there on the internet where they present the charts prices in a chart form. Many sites. Okay, so there are some types of charts they use. Okay, they use some types of charts they use. So one chart, we start with the first very simple chart. This is a chart, line chart. Okay, this is the simplest form of the chart. Okay, it is basically just nothing but it is joining of the dots. We can say it is a joining of the dots. So it can be, we can say that this can be even for a very simple, we can say it is a very simple. So what do? We, from this point we start, here we join connecting dots. It is also called the joining, as I told you, connecting dots. Okay, successive periods. Now, very important to note that whenever we use a line chart, we always use the closing prices. Okay, we always use a closing price. It is very important to note that we always use a closing prices. So we, for every successive closing price, we use it. Okay. Now data plotted, what we final on time frame. Now next question comes time frame. Whenever we talk about the time frame, so it can be any time frame. It can be a day. Okay, it can be a day. It can be a week, or it can be a month. So say here I can say that first day, second day, third day, fourth day. Even I can compare it with the like this we I can compare it. Even I can compare it with the say average closing price of a first week, average closing price of the second week, average closing price of the third week, average closing price of the fifth week, and average closing price of the sixth week. Similarly, I can average closing price of the first month, second month, third month, 4 months, fifth month, and 6 months. So these are generally can be driven by the averages, and these are can be the actual prices. So this is a very simple chart for the analysis. And generally, of course, it is generally used, but uh, what is the main actually what happens, I tell you, it is main problem with this chart is that it generally does not indicate the daytime volatility. Okay, generally does not indicate the daytime volatility, rather than they show the primary trend. Okay, they indicate the primary trend. They indicate the primary trend. But generally for the day fluctuation, they does not let us know. Okay, due to this reason, the other type of charting techniques have been used, that is bar chart. Okay, so when we can say that while a line chart shows where the market ended. Okay, because we have seen that here the market have closed on this day, here the market have closed on this day. Okay, then market close on this day. So ultimately they show the closing prices. Okay, where the market has ended, but hides the battle fought for the day to reach there. Because ultimately there does not, we don't know what has happened during the day. To analyze full range of market, we require following. What we require, as I told you, opening price, highest price, the day, lowest price, and the closing price. Okay, so now let us see how it works. Okay, it works on a very simple fundas. Okay, it starts with some bars. Okay, so let us see here. It starts with the say opening bar is on the left hand here. It will come. It is here. Now say for I take a January 1. Okay, now the price opens at 50. Tyagi ji, 16 पे कराओ, गर्मी बहुत है। उसका लो की जगह ना हाई कर देना वो। Start on January 1, the price opening price is 58. So we put a bar sign here somewhat. Okay. Then highest price has gone to here. Okay. So we put a dot here. What I do here like this. We put a dot here. Okay. Similarly, the lowest price is 52. So somewhat we have come here. Okay. Or we can say here we have come here 52. Okay. Then close price is 68. So we put it and we put a some bar here. Okay. When we join through a line, it looks like it here. Okay. Similarly, on the next day, when it start with the 71, okay, highest price has gone to 73. Okay, this is highest. This is opening. Okay, lowest has gone up to 58. I think there is some graph issues there. Okay. Fifty-eight, we can ignore it. Okay, now when it has gone to 58 and then it has gone up to close. Okay, it has goes to close. I think here it has gone to 64 point. This is close price, or this is the lowest price. Okay, 64 point something. So we can see that we can draw the bar chart. So somewhat it indicates what is the trend. Okay, if we see here that our close price is little bit showing like this, it is gone up, slight correction. Okay, slight correction. Sorry, closing. If we go by the, let me compare it with the. Now let us see what is the trend here. If we join the dots of the closing prices, okay, if we join the dots of the closing prices, so first day closing was this much. Okay, next day closing was this much. Again, the prices of the closing price was somewhat here. Okay, then it was gone this. So we can, joining the dots, we can came to know that what is the trend. Okay, so that's why we can, of course, there is some, I think there was some error in drawing out the graphs. Okay, but sometimes even closing and opening prices are joined, they can comes like look like this. So this is a bar chart form. Okay, this is a bar chart form. Now in this chart, there was a problem. We have to analyze that this is a more, say this chart, there is one problem was this chart, that we don't know whether during the day market has improved or market has gone up or gone down. That is opening and there is what is the difference between opening and closing. So it was not visible from this chart. To overcome this issue, there is another techniques, Japanese candlestick chart. Students, very interestingly, whenever we talk about the technical analysis, you will you will see that now as we move further, the the terms of the technical analysis are usually associated with the common terms. Okay, like Japanese candlestick chart means there we use in Japan the candles are used, or they have, and basically this theory have been propounded by them. So they have compared the share price movement with the Japanese their candles. So it is just like a candle, uh, which indicates the price movement. Okay, this is known out. So what we do, it is identical to the bar chart. What are the features? But it is one of the it has main feature. It's visual effect shift. Okay, what the space between the open and the close and close from the is a rectangular body. It means, see, there is a space. Okay, in a bar chart, there is no space, only single line is there. Here we present how, because we can visualize the market price goes up and market price goes down. So according to this Japanese candlestick chart, the price, if the closing prices, okay, please note that if closing prices is higher than the opening prices, okay, if the opening prices going higher than the closing prices, so it indicates the hollow or white candle, white body. Okay, if the closing price is lower than, if the closing price is lower than, if the closing price is lower than opening price, then it is filled up with the black. Okay, if we filled up the body with the black color. True. This is the highest price. Okay, this is the lowest price. Okay, here it is the opening price. This is the closing price. Okay, I do in there with a different color so that it is quite look. It is the highest price. It is the lowest price. Okay. It is the opening price. It is the closing price. Okay. Now we come to, this is the candle. Okay. Again, lowest and closing price, sorry, highest price. Okay. But here now you will see that our closing price is lower than our opening price. So that's why it is shown as a black. Now, very important. Nowadays, this was an earlier version where black and white, black and or hollow or black body was using. But nowadays, for this, green color is used. If you see the charts nowadays on a website, they are generally, and instead of using this black and white, they are using, and for this, they are using the red color, more visible. So, and there is another technique. This is called doji candle. Okay, this is called doji candle. Now in this there is a no change. Okay, this is the highest. What I do, it is a different color pen. It is also called doji candle, and here it is the highest price, lowest opening and closing. So it is somewhat like look like this. And very important to remember, student, these lines are called wicks. Okay, these are, we can say, it is the thread that is going through, it is called wick. So here we can say that wick is visible only here, 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 but here in the all portion, it is called wick. So if we see that there are, we can also extend this analysis like in a for a even a for a doji there are variety type of are there, but we cannot, we will keep ourselves limited to up to this point only, because we can go more and more further. Then we are next coming to the charting techniques of it is involved point and figure chart. Okay, point and figure chart is somewhat we can say it discard the time, like here line chart, bar chart, and candlestick chart. These are daily period, successive daily period is important. But here, when we talk about this point figure chart, they ignore the time entirely. They say we have to concern with the market movement only. Okay, and that's why their purpose is solely to detect structural reversal in a trend by plotting only significant price movement. So they are generally more concerned with the change in the significant price movement only. So there is one practical numerical as well there. I'm just giving you the hint. Okay, generally what happens? Very simple methodology. Very simple methodology. But how it works? We just put a graph there. Okay, just like square, small squares are there. Okay, each box have some size. Okay, this value can be say 0.50 or whatever be it. Okay, generally what happens? It says that if the price movement, say if we are here we are using 27, 28. Now say our price is 27.50. Okay, so we can, it can come somewhere this here. Okay, so if either it can be come here or come here, because 27.5 we don't have any particular indicator. So generally we have to put some box size, because the minor variation like 0.50 they ignore it. Then smaller box create higher sensitivity. Now see, if as the small size of the box is smaller, more, and we can see the graphs clearly what is the trend, because even a small change can be looked upon. And reversal criteria similarly, uh, because sometimes it is also seen that up to what time we will consider a reversal. Now I show you how it works. Whenever price moves up, we show it by putting cross on, no other sign, only cross. And when price goes down, we indicate it by zeros. Now student, for the time being I am leaving this discussion here, because once when we will solve the numerical, it will more clear to you. Or we can do one thing, uh, okay, let us start solving the question, then it will be clear to you. Okay, now student, please refer the question number 2. Okay, now student, please refer the question number 2 from your assignment. Okay, so that I think it will be better time if we solve the same. Draw out a point figure chart from the following data in the graph provided. We have provided you the graph. Okay, let us start solving the same. So once we will solve the question, then it will be clear to you. Okay, of course, it is a part of practical point. We will take up the remaining questions we will take later on. Okay, let us start solving the question. Okay, quickly. Now see student here. Here the period has been given to us. Okay, the prices are there. Okay, these are the prices are there. Okay, this is the graph. Okay, this is the graph. Okay, this is the prices are separate. Okay, now here we have drought. We have taken the box size of 2. Okay, we have taken the since all figures are in even number, so we have considered this. Now what we do, we start first of all, we start with the first price. Okay, now our period 1 price is 48. So as a starting point, what we do, we put a dot here. Okay, now see, next day, whether there is a price increase or decrease. Please always remember X for price increase and 0 for price down. Here there is a price increase. So what we do, we put 2 crosses here. Okay, we have reached up to the 52. Now next price is 54. We put another cross here. Okay, then the prices have gone down to 52. So see, when we are moving here, so how we move here? We draw out zeros. We don't write here directly, rather than corresponding to it. Our movement is a code is a here, then we put as much number of zeros are there. Okay, again price have gone to 56. So again what we do, we start putting the crosses that way. Okay, again the prices have gone down to 54. So what we do, we put a 0 here. Okay, price has gone down up to 52. 0. Downfall again 0. So we see that unless and until there is a trend change, we move in the same column. Once which it changes the direction, then we move to the another column. Okay, unless and until there is a change in the direction, we continue in the same column, and once there is a change in the direction, we shift to the another. Then up when we it is 52, again the price rise to the 50 from 50 it has come to the 52. So we start putting here crosses. From 52 it has come to 46. Okay, so somewhat we can observe that the moment the price goes on increasing, the fall is also equally, the more fall takes place. So we can conclude that there is a somewhat downtrend. Okay, there is somewhat a downtrend. Okay, so this is a point and figure chart. This is a point and figure chart. Okay, student. Now let's move further. So that we have discussed core mechanics, the plot purely based on price change. Very important. Okay, X column denotes, I'm sorry, cross indicates the rising price trend and zero indicates this. Very good golden rule. Mixing of X and zeros is not allowed. So if we write here, it is totally incorrect. If we write cross here, it is totally incorrect. Okay, so strict boundary is there. We can see that between these three. When we make a comparison of it, okay, so somewhat it is somewhat, we can say it is a overall summary of, we can think that, okay, so we can see that data inputs close only, opening highest, lowest, and closing opening highest and lowest, and significant price movement. Okay, opening closing, it is not concerned. It is generally say what are the significant price change. So it can either be based on closing price, opening price. It up to you. Okay, primary visual focus, connecting nodes, protruding ranges, colored regular bodies. Okay, X up, X down. Okay, analytical strength, isolating the macro trend. It is generally concerned with the micro trend, visualizing the volatility of the daily volatility, and it is the reading the market sentiment and detecting structural reversal. Okay, then last is time dependence, time dependent, time dependent, time dependent, independent of time. Very important. Okay, now next we are discussing the market indicators. Okay, what is the market indicators? Yeah, इसका तो पहले का आया नहीं, मेरे को लग रहा है. तो यहाँ पे कैमरा कौन है? ठीक है, ठीक है, आ गया होगा पहले का. बच्चों का कहाँ पे आएगा? बच्चों का कहाँ पे आएगा? Okay, student. Now we are discussing with the market indicator. Market indicator. What are the some indicators that indicates overall about the market? Okay, so these are some indicators are there, like breadth index, volume of transactions, confidence index, relative strength index, and odd lot theory. Now, somewhat breadth index means it is, we can say that it let us know about, or we can say that it is somewhat indicates uh, by how many numbers the shares have increased. Okay, by how many numbers? So net advances, net declines. It means for how many number of shares there is an increase, for how many number of shares there is a decrease. So ultimately, we divide it by the total number of issues traded. So it indicates the breadth index. If it is on rising trend, so they give a indication that there is a bullish phase. If net declines are more, then it gives an indication that there is a bearish phase. Generally, it's a indicate technique. Generally, it is a we can say that it is somewhat indicates about the direction of the market, and somewhat it has been seen that if it confirms to the uh, Dow Jones theory that what they have completed, then it indicates that they are technically correct. Okay. Now, if they are contradicts, then of course they are moving in a opposite direction. Generally, these are on the trend of the market trend. Okay. So there are hardly any chance they will be going in opposite direction. Now, next is a volume of transaction. As I told you, volume is a very important criteria. So if the market is rising, okay, market is rising and sale volume, okay, sale volume is decreasing, okay. So we can say that of course sale volume is dwindling or it is not that much, but prices are rising. So it is somewhat indicates the bull market phase. Okay. Now market is rising, okay, and share prices are also rising, volume is also rising. So it indicates that a buyer or behavior, it is purely determined the buying behavior. Okay, there is can be no sentiments, only the buying behavior, because FOMO of the fear of missing out maybe their factor may be there. So demand is unsatisfied because supply is less. Supply is less. So this can be only buying behavior indicator. Then falling prices and increasing sales volume. It is a panic in the market. Okay, this is panic in the market and it indicates that there is likely to be bearish phase in the market. Okay, then if the both falling is there and indication the volume is also selling is there, so it means the market is slow down and there is no enthusiasm among the investor to make the sale and purchase. It is somewhat relating to that investors are sweeping away from the market. They are doing the less and less trading. Okay, somewhat we can say that it is a panic selling. Okay, and it is a small investors are leaving the market. So according to the Dow Jones and Dow Jones, the volume is a very important factor. It should confirm the same. Next is the confidence index. Okay, confidence index is basically it is a confidence in the market. Now, see, students, please remember, bond market. See, bond, as I told you in the earlier class, bond is a fixed category, fixed income instrument because they carry a fixed rate of interest, and generally, of course, they carry the lesser risk comparing to the equity. So from the confidence in the market index, we come to know that whether in what direction market is moving up. Bond yields behave in the opposite direction of the stock market. In bearish phase, capital flees to the fixed income, shifting yield down. Okay. Generally, what happens whenever bearish phase, I do it otherwise also. When there is a bullish phase, okay, everyone wants to earn the money. Okay, so investor who have deposited money or kept their money in a fixed or income instrument like bonds, etc., they will start bringing out their money and investing into the equity. So somewhat it indicates that market is in a bullish phase. And in that case, what happens? As more and more investors are putting out their money, so companies start offering higher and higher coupon rate, to attract the money. So at that time, yields goes up. Okay. On the other hand, what happens when the demand in the market is in a bearish phase? Everyone start pulling out their money from the market and investing in the bond market. So by doing so, what they find that, so at that time yield falls. Why? Because everyone wants to pump up their money, put the money in the market, in the bond market. So it is a choice of the company that they can say, okay, I will now offer, instead of 8, I will offer 7.5. Now investor who does not want to wait, they will say, okay, I am ready to invest at 7.5. Next, more money comes. Then company says, I will borrow this money at 7%. They say, okay, do it. So it is the index level. Similarly, high grade bonds yield to the low grade yields. So sometime even if the market if the market is in bullish phase, so what happens? High grade bonds even are not that much in demand. But when the market is in bearish phase, even junk bonds are also purchased. Okay, low grade yield are also acquired by the investor. So it is generally indicate high grade bond yield divided by low grade bond yield. Okay, so they want to take the chance. Fall in the confidence index, it means low grade yields are rising faster or moving slowly than higher grade. So because it indicates, because higher is on the upside, lower is on the this. So it means if even the lower are becoming stronger, okay, the gap is becoming narrower. So it means there is a downfall in the market. So confidence drops. Okay. I think this chart makes you very clear. Fall in the confidence index, low grade yields are rising faster or rising more slowly than high grade yields. Okay. Then next comes the relative strength index. Okay, relative strength index means we compare it we can compare the prices with the, or we can say that benchmark sum. Okay, we compare it with the prices of the share. What is our strength of the index or the prices with the market? Okay, say this is a security line. Okay, now see, if there is a bullish phase, okay, there is a bullish phase. So what happens? Index generally consists of the many shares. Okay, so of course your security may be rising at some particular prices of your security, any particular security may be rising at some pace. But since index consists of many securities, it may be possible that they are rising by a higher percentage of the rate. Okay, so this chart indicates that they are moving relatively faster. Okay, uptime they are faster, but when we talk about slight correction, here price has gone down that much, but index has not moved less than it. Okay. So this is the relative strength index. Now next comes the odd lot theory. It is very interesting theory. Now it says, what is odd lot? Student, have you any idea what is odd lot? Like 1, 3, 7. These are odd numbers. Odd. Generally, you see nowadays this theory has lesser meaning, the lesser importance. Why? Because earlier there was a concept of tradable lot, okay, market lot. And generally this lot size was used to be like in 10 share, okay, 10 share, okay, 50 shares or 100 shares. These are marketable lots. These were used to be a marketable lots. So what used to happen? Generally, if anyone is holding a 3 share, so it was used nowadays. It is a on totally on a demat form. Okay, in a demat form, it is just like a cash in the bank. Okay, so even 3 shares can be sold or purchased. You can find a buyer. But there was a time when generally the buyer was used to want their shares to be in some marketable lots so that they can sell it easily. Okay, so see if marketable lots like 10, 50 and 100. So why I want as a buyer, why I want 10, 50, 100 shares? Because tomorrow if I have to sell the shares, I want the buyer should also ready to take the lot. So earlier there was used to be a lot of 137. These were used to be called odd lot. Generally they are used to be sold at a discounted price. I show you how it works. Say a share price. It is I'm talking about the old days. Now you please remember that. Now there was a price of share is 100 of a marketable lot, say of 100 shares. Now if any seller approaches to me, they say, sir, I have 7 shares. Okay, I just said marketable lot say is a 10 share. Okay, any seller approaches to me, sir, you buy the 7 share. I will say why I will buy 7 share from you. He will say, sir, you can get, but I don't want it because this nobody, I may not get a buyer for the same. So he may say that, okay, sir, I offer you at a discount. So I say, okay, I will take it at a 90 rupees. Okay. Now another seller comes to me and he have a 3 shares. He says, sir, you buy the share from me. I say, I know 3 is not at all. But what I do, I say I will purchase it at a discount. He say, okay, sir, you buy it at a discount. I say, okay, I will buy it at 87. Now, what I am sharing with you, I have done it practically in my earlier days. Okay, after my passing my CA, when I started my own business. Okay, so I have done used to like this. Now see what I used to do. I paid him overall. I have paid 890. Now what I do used to what I do, I combine these two shares. Okay, put them and I add them. Transfer deeds are attached to it. There was used to be some transfer deed, and I sent certificates to the company. And when I transfer it in my name, the complete 10 shares are transferred in my name. So now it becomes a marketable lot. So say share is trading at say 100 rupee. So by 10,000, sorry, 1,000, if I sell it at a 1,000, then how much profit I make? So this I used to do the practically in those days. I used to do the practically, but now this is since I am not trading right now, I have left the market trading, etc. All the things. So I think this has no much more important here nowadays. So now, as per this theory, if the odd lot demands shares is going up, so it means there is a boom in the market. Okay, there is a bull phase in the market because suggest trend that demand gains help to predict tops in the bull market and induces reversal based on the influx of the retail supply. Even small it is companies start demanding the shares. Okay, as an investor. So if the demand for these odd lots goes up, it indicates a bull market. Then there is another term, support and resistance. This was market indicators. Now, before we move to further market analyze charts, there is one term, support and resistance level. Okay, after this, we shall analyze the charts. Okay, so student, I think before we discuss this support and resistance level, let us have a small break of 10 minutes. Sanket ji, break started. Okay, it is 8:32. I will reassemble it at 42. Okay. Okay, student, welcome back. 1 second. Chat भी देखे. Chat देखना है. Chat. Okay, Breadth index again. Okay, Ravinder, now I take up to the breadth index. Net advances, net decline. Say net advances and net decline. See if now how it supports now. Generally, it of course this chart B is rarely happens. Okay, but sometimes see what happens. Generally, Dow Jones since takes the closing prices. Okay, and more or less they are generally more we can say that concentrated towards the index value. Generally, they take the index shares. Okay, the shares that consisted in the index. On the other hand, this breadth index is overall of the market pulse. Say in a market there may be 1000 companies. Okay, whereas in index the companies are mainly 100 companies or 50 companies or 20 companies. Now what happens if the generally the Dow theories वगैरह generally concentrated with the blue chip companies. So what they do sometime, of course they are showing the rising trends, but overall there is some decline in overall market. So sometimes they may contradict it. Okay, they may contradict it. So it is quite, see, technical analysis is cannot be say it is 100% science. It is somewhat subjective and it is also there. Anyhow, I will, if possible, you give me a call. Okay, I will discuss you over the telephone. Okay, Ravinder, you just give me a call. I will share my number. Okay, then we will discuss it in more detail. Now, before we move to the chart portion, let us discuss some very important point, that is support and resistance level. Now, support and resistance level, it is nothing but it is somewhat we can say that it is the price behavior. It is a price behavior, that how the price we can say supply and demand behave. Okay, so now let us see the chart. This chart I have drawn it from the data given in your study material. Okay, you can take a pic of it also. Okay, of course right now the chart is wrong. Okay, I am going to replace the same. So please replace the chart in study material with this chart. Okay, student. So there are two lines are there, stock A and stock B. Okay, now when we have drawn it, the prices, so we came to know what is their resistance level and stock level. Just let me take the study material so that to me also as well. This is page number 4.25. Okay, so here I'm writing it is a price of the company B and it is a price of company A. So we can see that I think yeah, I do it. Yeah. Now we can see that the price is moving like this. This is a company B price and this come. Now we can draw one inference that below for company A, the price is not going below it. And at this point, it is not crossing the same. So it is a kind of a threshold limit. Although the price is moving like this, but the moment it reach here, it goes down. It goes down, but here it touch upon, then again goes up. So we can say that it is the resistance level. about this, the price will not resist price normally resist to go above it, and this is the support level below which the price will not go. Okay, it is somewhat basically related to the, we can say that, behavior of the demand and supply. So the, because it is generally, we can see that we can generally observe that it is generally when the prices are coming down, say it practically happens generally when we say that, say price is at this price, oh price has gone down, let us start buying the share. Once the start people are buying, then it comes here. Similarly, when the price gone there, people have start selling the particular company share, and then it comes down. Okay, so this is called similarly for the company B, we can see that the price is going like this, but once it is here, it goes up. So it is our support level, and this is our resistance level. Okay, now let us start quickly analyzing this interpretation of price pattern, so that we can start our with the rest of the part of this numerical question as well. Now there are, see students, there are some patterns. Okay, we shall observe that these are some patterns, and I have these patterns are I have shown by way of in the, as it has been given in the your study material. Just okay. Okay, this is a list I have given to you as per your order in study material. But please always remember, this price pattern indicates there are two type of price pattern. There are some pattern like this. They are temporary pause. Okay, there may be some pattern we will see. Of course, there is some you can down, fall or um, fall or increase are there, but these are some temporary pauses. Ultimately, the major trend follows. Major trend follows. Okay. Then there is some reversal pattern, change which indicate the change in the major trends. Okay, now let us see how it how we. So we start with the some. There are some like channel, triangle, phalanx, and peanuts. These are gaps. These are some. We can say that these are the small pauses are there. Okay, I have changed the order, and then these are wedges are that from the wedges onward. We shall discuss there that indicate the reversal pattern. Okay, let us start discussing the same. This, what is this channel? Okay, when you can refer the theory from the study material, it will be more clear to you. However, we can see that the prices are moving like this. So we can see that the price is within the some range. But overall, first top, this top, let this top is greater than this top, this top. So ultimately, it is giving some this some small pauses. Okay, these are giving some small pauses. Ultimately, the primary trend continues. Similarly, there is another formation, triangle formation. Okay, this is a triangle formation. In this, we can see that the price is moving like this. So ultimately, we can see that this top is lower than this top. So subsequent tops are lower than this top. So it indicates the primary trend. Okay, this is the primary trend. But see here, the downward is also, we can see that, but ultimately we see this. This is higher than it. This lower is higher than previous lower. So ultimately, they can some forces. These are some small pauses are there. Okay, they may not generally indicate. Ultimately, what will happen? This will line up there, and ultimately, so these are some pauses are there. Small pauses are there. That does not matter. Okay. Similarly, flags. These, see, whenever we discuss here this, these are some shapes. Okay, so these are some pauses in the market. Now flag and pennants are the small flag. Pennants is a small flag. Okay, so ultimately we see that they are some indicating some range, but ultimately it is going up. So this is for the time being. Similarly, this flag is also going like this. Pennants is also like this. So these are some. Now another is a very important gap. Okay, so see what is the gap. Sometime what happens that does not trading does not take place, and when there is a take place, it is as a higher price. So if gap is more, day one is close and this gap is up, so it indicates the bullish phase. Sometime, no, sorry, it is does not, main trend continues, but sometime the gap may be due to we can say that demand has accumulated for the time being. The moment open the market, there is a variation, but this variation will be not last for the long. Okay, suppose as an investor I was ready to buy something, but since after 1 or 2 day market could not be open, so it may be possible that first I may quote a higher price, but later on when the selling pressure is will be there, I may quote a lesser price. So this from this is a temporary pauses are there. Then from this wedge means it is just like a nail. They start indicating the, we can say it is a trend reversal. From here we discuss the trend reversal. Now here the price goes like this. Of course it looks like a triangle, but here this like it will more go down. So we can see that this wedge is a starting point of a trend reversal. Wedge is a starting point of the trend reversal. So it can indicate there is some downward trend. So it can indicate a wedge can indicate a trend reversal from bullish to bearish. Then next is head and shoulder. Head and shoulder means price goes up. So we can see that this lowest is higher than this lowest. So it indicates there is a bullish phase is starting. The bullish phase is starting. So it is an indicator of bullish phase. Okay, similarly opposite to it, we can say like this. This is inverse head and shoulder. So the lowest because here we can see that okay, this is called. Then other trend reversal like this, there are trend reversal indicators are double top and double bottom. Now next we discuss the mathematical indicators, because after that we this is one of the last, I think second last topic is there. After that we shall discuss the market efficiency theory. While charts and patterns rely heavily on the market analyst's visual perception, subjective interpretation, it is very important. Charts, as I told you, charts are generally subject to subjective interpretation. One may view it as a other way, the other may have a different view. Okay. Mathematical tool processes the raw data to eliminate this noise. Okay. These formulas provide objective buying and selling, either confirm or contradict the visual pattern. Sometimes this may be this. The mathematical engine provide a smooth logics. So there are two indicators that normally we use, and for this we have also numerical question. One is exponential. For this we have a numerical questions. So what are these? First is arithmetic. First is arithmetic moving average. Arithmetic moving or simple moving average. In this, what we do, it is used by, generally it is, first of all, it is based on closing prices. Okay. Now these prices can be of say 10 days, 60 days or 200 days. So what we do, moving average, I need to explain you. Say there are these are the days. Okay. If I have to calculate say 5 days moving average. So first on 5 days I calculate this moving average like this. So I take up the prices of the, add up the prices of this 5 days and divide by 5. Okay. Now if this was a moving average of the 5th day. Now if I have to calculate the moving average of the 6th day, similarly if I have to calculate the moving average of 7th day, so I take up the total of these 7 days. So you can see that I am eliminating one by one day. Divide by 5, this will be the 7th day. Similarly, so we can calculate it for the 10, 60 and 200 days. 200 days or a 30 weeks moving price of the is used to identify the long-term trend. A 60 days moving average of the daily price to discern an intermediate price trend. Okay. Then 10 days moving average detect the short-term trend. Okay. So this is very simple. This main. Now next comes to the exponential moving average. Okay. Now, of course, moving average is important, but exponential moving average is more used by, because in a moving average, simple moving average or arithmetic moving average, equal weightage is assigned, that is 1 by n is assigned to each price. Okay. And whereas in exponential moving average, the highest weightage is attached to the latest price because they indicate the latest trend. They indicate the latest trend. So they attach the highest importance to the latest price, and accordingly what they do, they compute it like this. Okay. Exponential moving average of any particular day. A is an exponent. Okay, exponent we divided by number of days or number of trading days in a year, in a calculation, in a month, whatever we are using, plus 1. Okay, divided by this. So this is an exponent or a multiplier. It's also called multiplier. Plus 1 minus A exponential moving average of the previous day. Okay, this can also be write that closing price of the day exponential moving average of the previous day into exponent or the multiplier. Okay, minus previous day EMA. Okay, when we compare this EMA with a simple moving average, so it speaks, we can say that, suppose if we are comparing it, now this is our price chart, simple. Okay, now when we draw it out, okay, so we can see that it is more indicative. While here the average pricing is like this, here the EMA is telling the actual figure. So it has a tight correlation to the recent trend. Because we have a smoothing constant, or also called the multiplier, that gives the more weightage to the recent days. Okay, student, let us do one thing. One second. Okay, we do one thing. We will solve the question in a later part, just 5 minutes more, so that we will start working. We will do the because then we'll start the other question, one more question on the assignment that is relating to our market efficient market hypothesis. So these are the evaluation of the technical analysis. You can refer it from the study material. I'm not repeating the same here. But when we talk about this overall, from this technical and fundamental analysis versus technical analysis, so these are some major differences. Okay, objective determine intrinsic value, and objective is identify trend and trend reversal. Core questions: where to invest, when to invest. Sources are data, companies report, that GDP, etc. Here generally the internal market information is very important, price and volume. Okay, company performance and market forces, macro drivers. Here it is a pure, of course macro driver is there, but it is a demand and supply drivers are there. Okay, so now we are coming to the last part of our discussion of that. This is called efficient market hypothesis. Now student, this theory was developed by Fama in somewhere in 1990, and it studies the behavior, or we can say it is a psychology or response of the market on the information relating to the company. Okay, relating to the company or any economy, any information, how it is. So this theory states that no investor can, that as per this theory, all available price sensitive information is fully reflected in the securities price. So when it is reflected in the securities price, no one can make the super profit. Okay, no one can make the super profit, or no one can outrightly outperform the market, as every stock is priced based on the available information. So it means market discounts everything. Okay, market discounts, it is based on this assumption. Stating otherwise, this theory there, no one can beat the market. This is the basis of the efficient market hypothesis. No one can beat the market because whatever with the in the stock market. So how this market? Now it says that the share price is going like this. Any news comes, price may react like this, or it may also react like this. It depends. What is the nature of the news? So we can say that ultimately efficient market hypothesis, it is reacts. Now when we talk about the market levels of, there are all levels. It is the, we can say, degree with which the market reacts to the information. Okay, so there are three form. One is weak form, semi-strong form, and strong form. So let us analyze what are these forms. Now when we talk about this weak form, okay, current price reflect all historical data. It is very important. All historical data. Okay, so it means reaction to the news is information is slow. Then there is another form, semi-strong form. It is more reactive to the information. Fully reflect publicly information, publicly available information. It is very important. All information that is public information, and fundamental analysis hence useless because publicly information available, everyone can react to the same. So it is on the any news, say in the news paper or any news come in the TV or any media, the public investor immediately reacted. Then there is a strong form, public as well as private, and that is insider information. Okay, even corporate insider cannot achieve. See here, the corporate insider can have some profit in a semi-strong, but in a strong form, even a corporate insider does not have a form. So generally this case I also discuss. See, insider information acting on the making, selling, and purchasing based on the insider information is a crime. It is totally banned by SEBI. Okay, so I remember that before, nowadays the reaction on the insider information is quite we can say it has become a panel, it invites panel actions, but earlier time that was not in the ambit of the SEBI, or we can it was not in the radar of the SEBI. So I remember that somewhere around in 2009 there was some news that Global Trust Bank is merging with the ICAI Bank. So I think this news, just there was some negotiation was going on. So ultimately they have not come out with any swap ratio, etc. But due only the spreading of this news, the market reacted so fast. The share of the Global Trust Bank have risen. Okay, because it is expected that once this will be merged, so every Global Trust Bank shareholder will get some proportionate share, and ICA share on those days was on a very high rate. So ultimately this is a reaction. So strong form, even insider information happens. And please remember, generally in a WhatsApp we receive the message, we receive the message there is an insider information. Please don't do any trading on this basis, because doing or acting or doing any trading on the insider information can invite the panel actions. Now then it comes the how we test the weak form of correlation. Now there are some methodologies are there. One is correlation test. Okay, we analyze the correlation. Say what we do, we analyze the price of the first 10 days, then subsequent 10 days, or it can be more. Okay, then we compare then we compute the correlation. There is a numerical for the same. Okay, then it will be more clear to you. Okay, then if the correlation is lesser, okay, then there is a correlation lesser. Okay, so it means it indicates that the weak form, it indicates moderate, you can say if it is on a higher side, so like here we have mentioned a calculated coefficient of 0.1 reveals a moderate degree of correlation. It because it is not zero, predictability remains. Okay, so it means we can predict something, how it is reacting. So breaking the weak efficiency, if it is a zero, okay, there is no relationship between the reacting agent. So we can say that it is because see what happens. Generally, market reacts very quickly. So we have to see how it is reacting, whether what is the impact. So that will be clear from the question. Then we will take. Okay. Then there is a run test. Okay. Then we take a run test. Okay. In the run test, generally what we do, we compute the test of significance and the jet probability distribution. If the sample size is greater than 30, we utilize the jet test. And if sample size is less than 30, we use the T distribution, test of significance. Okay, this is a statistical technique from where we see what are the changes. Okay, so from this we can determine whether how the market is reacting. Then there is a filter test rule. Okay, then there is a filter test rule. Analyze establish a strict threshold band under which the set is moving average. Okay, so if it is crossing it, so it means the it has start reacting. Okay, if it is moving somewhere between the same, then it means there is a weak form of efficiency. Then challenges to the EMF. This is you can refer from the study material. There is nothing earlier. So this was from my side as a discussion of the theoretical aspect. As I told you in the beginning, there are some topics have been not been covered here. So you please refer it from the study material. Now student, now this part is over. Now let us start solving the question where there are two questions involving the weak form of market efficiency. Okay, then if the time will left, then we will do the one case study. So let us start doing the assignment. First question is now student, this is the first question. Question we are discussing. See, we have discussed this. We have discussed this in an earlier class. So today, this is a question number 3. Okay. The question number 3 says like this. This is from your study material. Okay, it says closing value of BSE Sensex from 6 to 17 day of the month of January 2000 X were 200, X was as follows. Okay, these are dates. Okay, sorry, these are dates. Okay, and these are days, and these are the Sensex. Calculate the exponential moving average of the Sensex during the above period. The previous day moving average Sensex can be assumed to be 1500. The value of exponent component for the 31 days EMA is 0. This. Now student, please remember that this value can also not been given to you in the question. It may be possible that. So how will you compute this 0.62? See, multiplier, basically it is a multiplier. Okay, multiplier is n plus 1 So 2 upon 31 plus 1. Okay, 31 plus 1. So when we solve it, let us get what will be the value 32. It will become the value of 0.625. Of course, it has considered up to this decimal point only. So let us start how we can solve the question. Now let us compute the EMA. First we write the date, first column, then Sensex, okay, this is column number 1, column number 2, column number 3. Sorry, this is 1 second. This is column number 1, this is column number 2. Okay, for column number 3, what we do like this, 1 minus 2. Okay, this is column number 4, 3 into 0.062. Okay, then column number 5, we compute the EMA. And how we will compute? 2 plus minus, whatever be the position, we will do this. Okay, now first day we start with 6, 7, 10. Or I do this like this. Oh, 1 second. 6, 7, 10, 11, 12, 13, and 17. Why column is this? Because we have to multiply. We have to multiply here. See, we have if we go by the formula. Okay, if we go by the formula, because we will compute the EMA of the previous day. Okay, here the sense. I will just wait for some time. Ravinder, just wait for 1 minute. Then I will show you how, because it will be used in the formula. Because EMA of the previous day is deducted, then we multiply with the exponential component. This is 16,000, this is 17,000, and this is 18,000. Okay. Now it has said that, assume that the previous day EMA is 15,000. Okay. So 1 minus this means this minus this. We compute it. We get the value of 478 is a negative value. Okay. Now we shall multiply with the exponential component. Ravinder, is it clear to you or not? Because in a formula, we are multiplying with the difference. Okay. Now when we multiply it with, we get the value 29.636. Okay. Now we add it to the 2 plus this. So second value is our this much. when we add up this much, we get the value of okay. Now, student, regarding the rounding of the value, you can do it up to you. It is not a hard and fast rule if unless and until something has been mentioned. Now, this will become the previous day EMA for this value. Okay. So this will become shift here. Okay. This minus this. Okay. Now, again, this value will shift here. Again, this value come here. Side by side, you can also start solving it. Now, from the EMA, we can see there is a rising trend. Okay, from the EMA, we can see the rising trend. So accordingly, it is expected that bullish trend is likely to continue. Okay, and investor can take a long position. Okay, we are coming to the fourth question. This was from the earlier examination. Okay, here we have given the prices, three prices, four prices, open, high, low, and close prices have been given to us. Okay, and we have to find. Mr. X is of opinion that the market has recently shown the weak form of market efficiency. In order to test the validity of impression, he has collected the following data relating to the movement of Sensex for the last 20 days. So he has collected the Sensex because Sensex is the indicator of the market. So these are the prices. Okay, these for the 20 days. To test the weak form of market efficiency, to use the correlation test. Okay, with a lag of time lag of 10 days. Now here student, please note that time lag is of 10 days indicate that correspondingly for the 10 day, first day, 11th day, 12th day, 13th, 14th, 15th, 16th, 17th, 18th, 19th, and 20th. So accordingly, what we shall do, we shall compare this day's prices with this days. So correspondingly, we keep the prices over there to each other. Then we shall determine the degree of coefficient of correlation. So let us start solving the question. So the question number 4. Okay. Now what we do, we write the period here 1. Okay, days are okay. Here are the closing prices and here the change. Okay, correspondingly, what we do, period 2 is there, closing prices, okay, and change. So we start writing closing prices. Here we write the change. Okay, so there is a decreasing, so we use minus. So there is a decrease 2.9. So we comparing with this with this. So previously we will see what are the changes are there. These are the 10 days analysis. We have put it here. So accordingly, okay, student. Now here I am for the corresponding change. Right here the prices for the period 2, that is another from starting from the 11th. So period here comes 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Again we shall here compare the prices. Okay, so similar day 1, 11th day price is 33. So the change is positive 34.36. Now I am not writing the prices. You can write it at your own. I am just quickly writing this because time left is small time have been left. Okay, now we shall compute from these changes. We shall compute the coefficient of correlation. Okay, one we take as x, another is we take a y. Sigma, it is minus 1.94.96. It is 68.08. Okay, x bar is equal to minus 21.66, and here the y bar, that is mean value, is 7.56. Okay, now next we compute x square. X square is equal to 68 is. Then we compute the y square. Okay, so overall this I am putting it here, 6754.74. Then next column is xy. We multiply this with this. So sigma, this is y square, this is sigma xy equal to 1668. Okay, now we compute the coefficient of correlation. Okay, the formula is like this. First of all, we compute the variable A and variable B, sigma xy minus n x bar y bar minus upon sigma x square minus this. Okay, the value will come 0.624. Okay. Value of A variable will be y bar minus x bar. Accordingly, this comes 7.56 minus 0.624 into minus 21.666. So this value comes 21.08. Now we put them in a formula. Okay, student. So when we put up all this value, we get r square is equal to 0.164, and when we take a square root, it becomes this one. So it is indicating the moderate degree of correlation. So it means there is weak form of market efficiency does not exist. If it has been 0 or something less, then we can say the market independent and weak form is there. Okay. Now, student, please note that there is an alternative approach to compute the coefficient of variation. Generally, it is in the mind of the student that there is only one approach. So quickly, I am discussing with you the alternative approach also, so that before we wind up our session, there is still time is left. So I am discussing with you the alternative approach. Yes. This is not covered in study material. It is for only for I am discussing here. This is simple. I am using the class mean coefficient of calculation of. This is a direct method. Yes, earlier we have done the indirect method. Okay, we add up the same. We get the value 194.96. X bar is that is a similar that we have computed here. Okay, now we start computing the deviations. So x minus x bar. We square it up. Compute the variance. Okay. So we divide it by the 2625 is this figure. See, first we compute this 2625 divided by 9. Okay, number of items is 1, 2, 3, 4, 5, 6, 7, 8, 9. So okay, so we compute the standard deviation. Okay, so when we compute the standard deviation variance, it comes 2625.40 divided by 9. It comes 291.71. Okay, we take a square root of the same. it comes 17.08. Okay. Similarly, we can compute the value for the y and y minus x. Okay. Y minus x, y minus y bar square, and x and y. Okay. X means x minus 1 second. Okay, so we can say that it is a column 1, 2, 3, 4, 5, 6. Okay, so this 7 is equal to multiplication of column number 2 into column number 5. Okay, so I am writing one these figures. Remaining figure you can write yourself. Okay, so this total figure comes 169.39.44. Okay, so this figure I am writing here, you write it total I am writing here. Yes, 6,952. 76.92. Okay, this y is equal to, we take a square root, it becomes 8 point. I think there is some calculation error. Sorry, it became 6 to 9. 9.95. Okay, this value comes 692.22. We take a square root of the same, it becomes 26.31. So this will be our standard value. Okay, now we apply the formula for coefficient of correlation. So covariance, this last column is the covariance. We compute the covariance divided by this. Okay. So here we compute the covariance of x and y divided by standard deviation of x, standard deviation of y. Accordingly, here 182.16 divided by 17.08 into 26 point this. So answer comes 0. So you can see this, we are getting the same answer. So even you can use this approach. Okay, student. Now we are see question number 4 is from your study material. So I will advise if you can refer from there. I am just doing one thing. Normally student face the issue in common problem is that this is a question is basically on the run test. Okay, so whenever we have to do the run test as per this, so first of all we have to calculate sign of price changes or how many runs we are considering here. So price change, there is one calculation, n is equal to price change, number of price changes. So it has to be calculated, then student mainly face the problem here. Okay, so what I am doing, I am discussing with you the how it is computed. 1 second. Now first of all we have to see sign of price change. Okay, so this we will leave here, it is minus, plus, plus, minus, plus, plus, sorry, it is minus, this is plus. Okay, then here it is plus, 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 minus, minus, plus, minus, 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 plus. Okay, now when we have to compute how many prices changes are there, this is 1, then this is 2, here same, no, this is 3, this is 4, we ignore the same, this is 5th, and minus we ignore the same, here it is 6th, 7 we ignore the same, 7, and here it is 8. So there are 8 changes are there. Okay, so number of sign changes is 8. Okay, and then we calculate the number n1, number of positive signs. Okay, and then we take the number of negative signs. Okay, so n1 is number of positive signs, n2 is basically the number of negative signs. Accordingly, we can use the formula of computing the value of mean, then we compute the standard deviation, and then we test the form. Now student, with this please solve the question at your end and from the study material, because this is the answer study material. Only I am taking the last question quickly. This question is question number 6. This question has come in the January 2026 examination. So student, please see here. Now when I talk about this question, I think this time you can easily answer the question because you have a fair idea of chart patterns, because this question was based on the chart pattern. It says a technical analyst at a portfolio management firm is tracking the stock price movement of 5 different companies. The analyst has described the observed chart pattern as follows. Stock of Dynamic IT Limited shows a series of uni rising peak and throws indicating a consistent upward movement. Okay. So this is somewhat channel. Okay, this is somewhat a channel. Okay, momentum model experiences strong downward price trend. Okay, this was followed by a brief period of consolidation after which the original upward trend resumed with a significant value. Okay, so see here, it is a flag. Upward trend with a strong down upward trend. Okay, 3 pharma shows 3 peaks with the middle one is the highest. Okay, what is this indicate? Please tell me, student, I expect this answer from you. It is indicating a major downtrend. These were the pauses. Any guess, please? It is head and shoulder. Okay. Then global steel income is contracting in a price range. Okay. Lower heights and higher lows. The direction of the eventually price break is currently unclear. So it is a triangle. And it is just like a pause because price direction is not clear. Then last is sunrise exhibit a pattern where the price high are consistently falling and the price lows are consistently rising. Trading range to the narrowing over. So it is a wedge. So student, with this we come to know that when we have analyzed the chart, so we can answer the question. Now there is one case scenario has been left. You can refer it from your study madam. Now student, as a customary, just before we end up the class, okay, so I will like to share with you my contact number. If you have any query, you can contact me. Okay, our email ID is sfm-finance @ICAI.in. This is in small letters. Okay, student. So with this, we come to the end of the one of the important chapter. Of course, theoretical as well as numerical question can be asked. So I request you to please go through the chapter thoroughly. And if you have any query, you please consult us so that none of the topic left and any of the topic of this chapter left untouched. So student, thank you for your patient listening and have a nice day. Thank you. Like one thing, any student has any query? Student, if you have any query, you are free to ask me right now. No problem. Okay, Ravinder, you can call me, but no problem. I will discuss with you. Okay, you can end the session. Thank you. Okay.